Barron's Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, can any investment compete with the S&P 500? Cambria Investment CIO Meb Faber on a few other places to put your money. And later, a potential Trump White House return is boosting certain sectors. We'll discuss how you can play the Trump trade and what you should avoid. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Megan Leonard, and Al Root. So, Ben, last week Liz Ann Saunders was on the show, and she said, volatility has nowhere to go but up. Right on cue, topsy-turvy week on Wall Street.
It was. And actually, I would say that this week was brought to us by the letter R for rotation, because we saw this idea that you had to get out of tech stocks and buy other things really take on a life of its own this week. All seven of the big seven fell this week, particularly NVIDIA got hit the hardest, and that brought down the NASDAQ and the S&P 500. But the Dow and the Russell 2000 both did pretty well, and that's partially because small caps did well, banks did well, and energy stocks did well. Tailed off a little bit towards the end of the week, but that was really the story.
All 493 stocks probably did better than NVIDIA and company. I'm sure there are a few that were worse. But the point is, it's out of the Mag 7 into the others. And so if you look at the equal weighted returns, those were much better than the broader index.
Right, that was the RSP, the equal weighted ETF. It finished about flat on the week, which, given the losses in the S&P 500, that wasn't bad.
Sure. Okay, what are you watching to determine whether this is just a blip, a funny week, or maybe the start of a real long-term secular change?
Well, what I'm looking at is the small cap stocks. They had an incredible run from over a 5-day period. They gained more than 11%, and they outpaced the S&P 500 by the most since, I think it was 1986. I mean, it's just an amazing run. The other thing was that 80% of them finished at 20-day highs, and that is actually good news for the S&P 500. It usually means that there's enough animal spirits out there that it's going to rotate in the S&P, which could gain another 10% over the next 6 months if history repeats itself.
Another sector that did well was financials. Megan, why are investors bullish?
Well, I think Wall Street's back. If that was the lesson to be learned, this is it. I think, you're seeing a lot of interest in investment banking right now, in many ways because of the economy. So we're sort of optimistic that the Fed's going to cut rates. We're sort of seeing the economy being very solid. This is a good news situation. M&A is back in the business. We're seeing some good experiences here. Now, Wall Street may be good. Consumers a little bit more shaky. So we're starting to see a slowdown in spending, and obviously that may hit a little bit more on the consumer side of the balance sheet. A rain cloud for sure to be looking at on the horizon.
If acquirers can borrow money for less, they can buy more things like M&A.
Right.
So Charles Schwab was a bit of a rain cloud on the horizon. What was going on there? I think that was way down. Let me check, 16% on the week.
It didn't have a good week. I think that's an understatement. But it's one of those situations where Schwab has been retooling for years, trying to make itself look a little bit more like a bank. And unfortunately, some of that hasn't exactly panned out for Schwab. We're sort of seeing some lingering issues with cash sweeps. We're seeing some cash deposits being down. So actually, the CEO said, I think we might revisit some of this. And so I think what they're trying to do is keep a little bit ahead. They do have a decent valuation here, a lot higher than your traditional bank stock. And so arguably, I think there's an idea that they need to pull back on the bank a little bit and refocus to make sure that their valuation stays solid.
Alrighty, Al, tough week for chip stocks as well, particularly Taiwan Semiconductor. Interesting thing where President Trump gave an interview, former President Trump, and he suggested that maybe the U.S. does not have an obligation to defend Taiwan. The stock got hammered.
Yeah, it was, you talk about the rotation, getting out of the Mag 7. I mean, that is almost, there's always a catalyst. The sounding week on Taiwan was sort of the bomb that went off. Taiwan Semi is almost $1 trillion company. It makes all the chips for everyone. Our expert reporter, Tae Kim, 90% of all of the advanced chips are made in Taiwan by Taiwan Semi. NVIDIA, Taiwan Semi makes their chips. AMD, Taiwan Semi makes their chips. It is a critical company. And, if you read the interview and the comments from President Trump, there was some notes about, sounded a little like NATO. We need to be compensated for the services we provide. He may want to walk that back eventually.
Yeah, Tae actually he said global depression would be possible if Taiwan Semiconductor was out of control.
Yeah. We're talking phones, washing machines. Everything has these advanced chips.
And the one slight bright spot, or not as dim spot, was Intel, which is kind of interesting because it's building this fab in New Albany, Ohio, and we have some other opportunities.
Yeah, but back to Tay's comment, the goal of the U.S. is to produce 20% of the chips we need by 2030.
Ooh.
So this is the kind of situation the world finds itself in with this unbelievably important company on this very, very small island.
And the Dutch company ASML, which makes the machines that make chips, they got hit too.
So they had a great quarter. Bookings were up. The stock was down double digits for the week. 30% of its revenue is generated by selling things to Taiwan Semi.
Wow, we do need to build some more chip production, I think. Thanks, guys. Over the past 10 years, diversification has gotten a bad name. Cambria's Meb Faber on the best investment strategy for the next 10 years, right after this. In this tech-driven market, investors who built globally diversified portfolios got steamrolled by the S&P 500. Should investors be rethinking their approach or continue to safeguard against potential bear markets? Here are some answers. Is Cambria Investment Management CIO Meb Faber. Meb, thanks for coming on the show.
Great to be here.
So, look, for more than 10 years, diversification has been really, really painful. Michael Kitces says diversification means always having to say you're sorry. Why has this been so rough?
Look, first of all, if you're an American investor and you put most of your money in U.S. stocks and bonds, which is what most Americans do, congratulations, right? Pat yourself on the back, because it's not just been a great 10 years, it's been an amazing 15 years. This is one of 4 times in history where the S&P is compounded for over a decade at 15%. Now, the other 3 have names. So you had the Roaring 20s a century ago, the Nifty 50s, and of course, my favorite, the Internet.com bubble. So it's not like this never happens. It just goes to show that it's pretty rare. And these good times, by the way, often lead to the bad times and vice versa. But for those who have been there and who have done it, kudos. It's been a great run. For those who have diversified, it's been a little more of a challenging. This is one of the most challenging periods for a globally diversified investor in the last 100 years. The only real comparable period would be post-World War II in terms of magnitude. And the hard part is years in a row losing out to the S&P.
So do we have a name for this period? Are you ready to name it, or are we going to wait till...
COVID meme stonk era sounds about right. I don't know.
Okay.
We got a little AI echo built in here, too. But if you come up with a better name, let me know.
I'll work on it. So historically, not going all in on whatever the winners were has eventually paid off. We're starting to see maybe some suggestions that that's starting to work now. What do you think? Is this recent rotation the start of a bigger trend?
The late, great Peter Bernstein had a great quote about asset allocation. He says, look, asset allocation is great because it's defensive, but also it's offensive. Like you never know where the next big gain is going to come from. And so that could be from foreign stocks. It could be from real assets like commodities or REITs or tips. It could even come from bonds. My goodness, we got yield again for the first time. But the whole point is you just never know. If you look at things like cocoa, gone crazy this year, gold's at an all-time high. So building this globally diversified portfolio, which, by the way, has done totally fine the last 15 years, done about 7% a year. The problem is 7 versus 15. And if your neighbor is doing 15, we all know that's the worst possible setup. But what happens when stocks do great for so long, they eventually get expensive, which is where they are now. They eventually get very concentrated, which is where they are now, one of the most concentrated periods in history, very, very similar to the 2000 or late 90s as well as the 1920s, and historically not a warm, fuzzy place to be in the ensuing decade.
So even if you were properly diversified 15 years ago, now you're pretty overweight U.S., especially big tech. Give us an idea, where do you like to be now? What looks cheap and has the potential to defend us against a tech slide?
Well, good news, when you go to the grocery store, you don't have to just pick brand flakes, right? You don't just have to pick S&P in the U.S. So the world is your oyster. There's thousands of stocks. We have a particularly strong opinion right now on smaller caps, so mid-cap, small-cap stocks, particularly high-quality value stocks with lots of cash flow. We call these shareholder yield companies. They're trading at much lower valuations, much better position, higher quality than traditional market cap weighted, which are very expensive. Now, also, if you look across the pond. So U.S. stocks, even after this run, are only about 2/3 of the world's market cap. They're only about 1/4 of the world's GDP. So these are long forgotten, so most investors won't have any, but foreign stocks, emerging market stocks haven't participated the same way that U.S. stocks have since the bottom in 2009. They're much cheaper. So foreign developed is cheaper, foreign emerging is cheaper still. And underneath the surface, these high quality value companies, it's some of the biggest spreads we've ever seen relative to the expensive, top heavy U.S. market. We think it's a huge opportunity, not just this year, but for the next 3, 5, 10 years as well.
Alrighty, Meb, we got to leave it there. Thanks so much for coming on the show. Appreciate it.
Thank you.
Investors scrambling to position for a possible Donald Trump White House. How to score playing the Trump trade next. Investors placing bets on Donald Trump winning the White House, sending some sectors higher while others head south. We're taking a look at which industries are getting the most interest. It's the Barron's cover story this week, written by Barron's senior markets analysis writer, Paul LaMonica. Paul, thanks for bringing you and your long title onto the show. It's great to see you.
It is a mouthful.
So we always recommend that investors keep their politics and their investment portfolios very separate. But at the margins, politicians' policies can affect a few sectors. So let's talk about those. The funny thing is, it's sometimes counterintuitive. Energy is a great example.
Yeah, energy is an area where there are expectations that oil stocks should benefit under a Trump second presidency. But if you remember, energy stocks got hit pretty hard during his first tenure in the White House, partly because there was so much drilling that went on that increased supply. And then you had the pandemic, which reduced demand. So that was a problem. But we hopefully won't have another pandemic. So if you factor that out, if oil stocks go up, it's potentially, if oil prices go up, that's good news for the likes of Exxon and Chevron, potentially some of the services companies as well, like Halliburton and Schlumberger.
It's always that funny dynamic. So what's good for drivers, low prices, is bad for investors as prices go down. Al, not all cars use gasoline, of course. You love your electric vehicles. That's been a fascinating dynamic because they've been hit, they've been helped. Elon Musk saying 45, or the Journal reporting that
Yes.
Elon Musk is putting $45 million a month into a pack has helped his fortunes, I think.
Yeah, it's been a wild week because at the beginning of the week, Elon Musk endorsed President Trump over the weekend. President Trump has said Elon is fantastic in various interviews, so you thought that maybe the tide was turning. And that actually sent Tesla stock up early in the week, Ford and General Motors up early in the week, ended up tanking shares of like Rivian and Lucid. The thinking being that if President Trump, rolls back some of the EV tax credits and things like that, that actually is good for Tesla. It has the scale and profitability to weather that storm. Some of the smaller startups, not so much. Good for Ford and General Motors as these things slow down. Then came the RNC speech on Thursday. He took a lot of shots at EVs, and basically everything got hit at the end of the week following that speech. So
even Tesla?
Even Tesla. Wow. So Tesla ended up the week down about 3%, but the Rivian and Lucids of the world, Rivian down 8, Lucid down 16. So you see how it was impacting the different stocks.
We know that Trump loves oil, drill, baby, drill, but that's not great news for alternative energy companies. Vistra, one of the utilities that had actually gotten an AI bump this year, has fallen more than 10% in July because of concerns about exposure to wind power. What are you seeing with regards to alternative energy in a potential Trump second presidency?
So the alternatives took it on the chin, that is for sure. And when President Trump rolls back, and we talked to some investors, and basically, to sum it up, if you take away some of the incentives, the production tax credits, the investment tax credits, it makes renewable power a lot more expensive to build and finance. So it effectively slows the rollout with the lack of subsidies. Now, that tends to be bad for utilities that do a little better when they build a wind plant versus if they build a coal plant, because effectively they don't have operating costs of coal, which is passed through to the customers. They earn money on the entire capital base. But the bigger trend, I think, that people should remember is the demand for electricity is growing faster than it ever has before. It's not all EVs. It's things like AI data centers, manufacturing coming back to the U.S. That actually benefits utilities, right? So I actually think this is more of an opportunity to buy the dip. Some of those renewable-centric companies, maybe not so much, but take a look at utilities like the Vanguard or the Vistras.
You know, Paul, I'm very curious. So obviously bank stocks, we've been talking a lot about them this week, but what do you think this means for the financial sector generally? A new, an updated, obviously, Trump presidency.
Yeah, I think there are hopes that in a second Trump term, you have a further relaxation of some of the more stringent regulations on banks. But let's be honest, the banks are going to rise and fall with Jerome Powell and what the Fed does if we do get rate cuts potentially in September and then several more this year and into 2025. You could wind up having more lending activity and also a rebound in M&A. That's very good news for your JP Morgan Chase, Citigroup, Goldman Sachs, Morgan Stanley's.
Assuming there is a Fed.
Of course.
But what about tech stocks? They've been carrying the market. How are they going to do?
Yeah, tech is an interesting dynamic because J.D. Vance has come out being somewhat anti-big tech, and in a rare show of bipartisanship in Washington, kind of likes what Lina Khan has been doing at the FTC. So you might have more concerns about enforcement against the likes of Amazon and Alphabet. But by the same token, AI isn't going away. NVIDIA and chip stocks have already had their day. You might start to see companies like Microsoft and Apple on the software and services side get some of that AI boost.
And we're almost out of time, Paul, but real quick, crypto, J.D. Vance is a fan, and Trump's kind of had a revelation on that score.
Yeah, crypto is now in the GOP party platform. So forget about drill, baby, drill. I think it's mine, baby, mine. So you might have companies like Riot Platforms and Marathon Digital, the big mining companies, get a benefit. Also companies like Coinbase. And then don't forget BlackRock, as they run the largest spot Bitcoin ETF. Bitcoin prices have actually held up pretty well in this recent bout of market volatility.
That's tricky. Of course, BlackRock sometimes persona non grata with the RNC, but we'll see what happens there. And Bitcoin itself could run up. Thanks a lot, Paul.
Thank you.
Great story there. Megan and Al have a pair of investment ideas, and Ben is looking at some crazy action in small cap stocks. Stay right there. For sports fans, stocks fans, crazy action in small caps this past week. Ben, what was going on?
Yeah, I mean, this is one of those things where, everyone talks about how great it is that the market is broadening out and that the small stocks are doing well. And you know what? That is great. If you're a stock picker, I mean, it's never good to have just a few stocks be the market. The problem is, though, that those Magnificent Seven stocks, I know exactly who they are. I know what they do. I know their ticker symbols, and I know the narratives behind them. And so it's very easy to follow. The problem is when you get in a rally like this with small caps, you get stocks like Morphic Holdings, AHR Test Systems, CommScope. I couldn't pronounce these names, let alone know what they did up until a few hours ago. And this is what the Russell 2000 really is. Small caps are lots of stocks that nobody's ever heard of, and we don't know what they do. And it makes it very hard to pick the stocks.
So if you want to be a speculator, I guess you can throw the dart at Morph. But what would be another approach?
Well, I think the best approach to small caps is by using either an exchange-traded fund or a mutual fund. There's the iShares Russell 2000 ETF. That's IWM as in Mary. You have the iShares Core S&P 600 ETF. The S&P 600 is a little higher quality than the Russell 2000. Or if you want active management, you could do something like the Boston Trust Walden Small Cap. That's BOSOX, BOSOX. It's an active fund that's going to be, you're paying someone to pick the stocks for you. Any of those might be a good option.
All right, I still like Morph. That's a fun name.
It's a good name.
Yeah. All right, time for actionable ideas. What do you have for us, Megan?
Well, I'm going to throw another name out there, FEMSA. So this is a really interesting company. They're the bottler of Coca-Cola, but that's not why you want to know what they are or what they do. So unfortunately, the stock took a little bit of a slump, and now is the time to buy. My colleague Teresa Rivera says, look, you know what? This is interesting. Not only is this company good with Coke, but they have a really fantastic convenience store chain that is expanding rapidly throughout South America. So it's a buy.
And Americans love Mexican Coke.
They absolutely do. I love Mexican Coke.
Al, what's your idea?
So amid all this rotation coming into Thursday trading, there was one stock that had done absolutely nothing all week. It was Newmont, the gold miner. And it was a reminder to me that sometimes it's good to have things that don't do what everything else is doing. And gold prices are up 20% over the last year. Newmont's only up 5%. Leaves it for trading for about 13 times 25 estimated earnings. It yields 2.1%. Newmont, gold.
For people who are betting on a Trump win in November, gold looks interesting because both Trump and Vance have been moving away from this strong dollar policy that's kind of been doctrine in Washington for decades. So gold would do well under that that administration.
Yeah, it could catch a bit with falling interest rates, too.
Alrighty, thanks, guys. Before we go, an update on our Wall Street Journal colleague, Evan Gershkovich. On Friday, we learned that Evan was convicted of a fictitious charge of spying in a sham Russian court. In fact, he was an accredited journalist doing his job, but he was sentenced to 16 years in a maximum security penal colony, a sickening and unjust verdict. Dow Jones continues to work for his release, and that's all for us. To read more, check out this week's edition at Barrons.com. We'll see you next week on Barron's Roundtable.